Welcome to the Insurance Producers Guild, delivering intelligence for independent agents to help you stay ahead of the trends shaping Medicare, ACA, life insurance, and the broader insurance market landscape. Let's get started.
Have you ever noticed how, a seemingly distant change in a corporate boardroom halfway across the country inevitably trickles down to your own wallet?
Oh, absolutely. It always does.
Right, because you read a headline about a CEO stepping down or, I don't know, a shift in an insurance policy, and it just feels like abstract business news.
Yeah, just background noise.
Exactly. But give it a year or two, and suddenly it's dictating how much you pay at the pharmacy or how you're forced to plan for your retirement.
It's the butterfly effect of finance and healthcare in action, really. A decision made on Wall Street today becomes your kitchen table conversation tomorrow.
Which is why today we are going on a deep dive to connect those exact dots. We're looking at these tectonic shifts happening right now in the insurance and healthcare sectors and figuring out what they actually mean for you.
And to get to the bottom of this, we pulled from a really diverse stack of sources. We've got the latest industry sales data from LIMRA, which is the Life Insurance Marketing and Research Association, along with corporate strategy news from Reuters and Forbes.
Right, and we're combining that with some highly impactful Medicare policy updates we pulled from GoodRx and Boomer Benefits.
Exactly.
So we want to give you a quick roadmap for the next 10 minutes or so of this deep dive, just so you know where we're heading. We're looking at 3 interconnected trends.
First, a record-breaking gold rush happening right now in retirement products.
Second, an executive shakeup at one of the biggest healthcare providers in the country.
And third, a brand new prescription price cap that is completely changing the game for retirees.
Yeah, and by the end, you'll see how these 3 seemingly separate stories feed directly into each other. But let's start with the money. I keep seeing these headlines about a huge boom in life insurance and annuities, but I don't have the actual numbers. What is the data telling us?
Well, the data from LIMRA paints a picture of a market in absolute overdrive. Total U.S. annuity sales hit $461.3 billion in 2025. Yeah. It's the 4th consecutive year of record-breaking sales. And the momentum is only speeding up, honestly. The fourth quarter alone jumped 12%, hitting over $114.4 billion.
Almost $500 billion flooding into annuities in a single year. That feels like a panic response. What's the psychology driving that kind of capital migration?
It's entirely driven by anxiety, specifically longevity risk.
The fear of outliving your money.
Exactly. According to research, 54% of baby boomer and Gen X investors are actively terrified of outliving their assets, and that number is up 6 full percentage points from just 2024.
That makes a lot of sense. If you retire at 65 and live to 95, you're funding 30 years of life without a paycheck.
Right. People are looking at their life expectancy, calculating the elevated cost of living, and realizing their money might run out decades before they do.
But wait, if annuities are designed to solve that exact problem, providing guaranteed income, why do they have such a complicated reputation? If they're the ultimate safety net, why doesn't everyone just have one?
You've hit on the central paradox of this entire industry. The data shows that 90% of investors fully recognize that annuities mitigate longevity risk. They get the concept.
Right.
Yet fewer than 1 in 5 actually own one. Because historically, consumers have been extremely hesitant. Traditional annuities could be rigid, complex, and
too heavy.
Very fee heavy. You handed over a lump sum, and if you died early, the insurance company often just kept the balance. That terrified people just as much as outliving their money.
So what changed? Why are sales suddenly breaking records if the fundamental product is so polarizing?
Because the industry evolved the product to match the current consumer mindset. The biggest growth is in what they call indexed products. We're talking about registered index-linked annuities, or IGELO ILAs, and fixed-indexed annuities, FIAs.
Okay, index products.
Yeah. A decade ago, these made up about 24% of the market. Today, they represent 45% of all annuity sales. Our ILAs alone hit $79.6 billion last year.
Almost half the market is buying these now.
Yeah.
Let's break those down. How do they actually work in practice?
Think of them as guardrails for your retirement account. Consumers want the growth potential of the stock market to fight inflation, but they cannot stomach the idea of losing their principal if the market crashes.
Right, because of all the economic volatility lately.
Exactly. Index annuities sit in that sweet spot. Your returns are linked to a market index, like the S&P 500. If the market goes up, you get a piece of that growth. If the market crashes, your principal is protected.
It's the ultimate have your cake and eat it too pitch for a nervous retiree. But the Limray report also highlighted a surge on the life insurance side, right? It isn't just retirement income.
Far from it. The standout statistic is that whole life policy counts surged by 18% in the third quarter of 2025.
18%.
Yeah, that is the biggest jump the industry has seen since at least 1990.
In a single quarter for whole life insurance. That is usually such a slow-moving product. Who is suddenly buying all of this?
It's largely being driven by middle and lower income households purchasing what the industry calls final expense products.
Oh, like smaller policies, specifically designed to cover funeral costs and medical bills.
Exactly. So the family isn't burdened. The driver here is a startling coverage gap. Currently, 100 million Americans live with either no life insurance or significantly less than they need. People are rushing to close that gap.
So the theme here is individuals desperately trying to buy certainty in an uncertain world.
Right.
Whether it's the fear of living too long or dying too soon, everyday people are aggressively managing their personal risk. But what happens when corporate America does the exact same thing, but on a vastly larger scale?
That brings us to Cigna.
Yeah. I saw a headline recently about a major shakeup over at the Cigna Group. How does their corporate recalibration tie into all of this?
The Cigna news is a textbook example of a corporate giant changing course to manage its own risk exposure. So Cigna announced that its CEO, David Cordani, is stepping down.
Okay.
He's 60 years old, been at the helm for nearly 17 years, and he's handing the reins over to Brian Ivanko, who's 49. Ivanko is stepping in with a base salary of $1.3 million.
17 years is an eternity for a Fortune 500 CEO. What's the legacy he's leaving behind, and what is Ivanko actually tasked with doing now?
Well, Cordani's tenure was defined by aggressive acquisitions. His crown jewel was the $54 billion purchase of Express Scripts back in 2018.
Right, which transformed Cigna into a massive pharmacy benefit manager.
Exactly. But the new direction under Ivanko is a sharp pivot. Cigna recently sold off its entire Medicare Advantage business to HCSC for $3.3 billion.
Oh, let's pause on HCSC for a second. They're a massive operator of Blue Cross Blue Shield plans across several states. So Cigna offloaded their Medicare Advantage division to them. Why would Cigna abandon that market? It's been heavily marketed for years.
From a purely business perspective, they decided the regulatory environment, the profit margins, and the future of those government-adjacent markets are simply no longer worth it. They're also shifting away from Obamacare marketplaces.
Just completely retreating.
Yeah, to double down on commercial, employer-sponsored healthcare plans and pharmacy benefits. And just to be clear, we're looking at the corporate strategy here, reporting on this impartially without taking any political stance on those government programs. It's just a business maneuver.
Makes sense. But investors don't usually like it when a company abandons a huge consumer base. Didn't their stock take a hit?
It did. Shares fell over 5% on the news. Wall Street hates uncertainty, especially because Cigna is transitioning some customers to a new model without aftermarket rebates. But the far more fascinating dynamic is what happens at the ground level.
The consumer level.
Right. When a giant like Cigna picks up its toys and leaves the Medicare Advantage space, it creates massive displacement.
Think about it from the senior's point of view. You've had your Cigna Medicare plan for years, you know your doctors, and then you get a letter saying your carrier is exiting the market.
And your coverage doesn't just seamlessly transfer. You are forced back out into the open market to shop for a new plan.
Which creates a feeding frenzy for insurance agents, doesn't it?
A massive one. The internal guidance circulating among insurance agents right now is telling them to capitalize on this displacement. When clients are forced to find new plans, local agents swoop in, offer a solution, and capture that business.
So a boardroom decision creates chaos for the consumer, which creates a localized gold mine for the independent insurance agent.
Exactly. But when these displaced seniors sit down to shop for new Medicare coverage in 2026, they are walking into a radically different landscape than just a year or two ago.
And this brings us to the third piece of the puzzle, where everything we've talked about snaps together, the new Medicare Part D out-of-pocket caps.
Yes. For anyone relying on Medicare for their prescription drugs, this is huge. For years, seniors lived in fear of the infamous donut hole.
That coverage gap, where you suddenly had to pay a huge percentage of your drug cost out of pocket until you hit a catastrophic limit, it routinely bankrupted people on specialty medications.
Well, as of 2026, the donut hole is completely gone.
Really, just gone.
Gone. To understand how dramatic this relief is, let's look at the out-of-pocket maximum over the last few years. In 2024, the cap was $8,000. In 2025, it dropped to $2,000.
Okay.
Now, for 2026, adjusted for inflation, that hard out-of-pocket cap is set at exactly $2,100.
Going from an $8,000 exposure to a $2,100 hard cap is life-changing. If you're managing cancer or taking insulin, we're talking about thousands of dollars staying in your bank account every single year.
Absolutely.
But Medicare is notoriously complicated. Walk me through how this new 2026 system actually works if I'm a retiree showing up at the pharmacy counter.
Okay, let's say you're taking an expensive medication. The system has been simplified into 3 distinct phases. Phase 1 is the annual deductible. For 2026, the maximum deductible a plan can charge is $615.
So I pay the first $615 out of pocket. What happens in February when I need a refill?
You enter Phase 2, initial coverage. You start paying just a copay for your medications. Your plan covers the rest. You stay in this phase until your total out-of-pocket spending reaches that new cap of $2,100.
Let's say my meds are so expensive that I hit that $2,100 limit by June. What happens for the rest of the year?
That triggers Phase 3, catastrophic coverage. Your plan steps in and pays 100% of your covered medications for the rest of the year. You pay nothing more at the pharmacy counter.
That offers incredible peace of mind. But let me play devil's advocate. If I'm on a fixed income walking into a pharmacy in January and owing a $615 deductible all at once can still be devastating.
It can, but they have a solution for that cash flow problem now. The government introduced the new Medicare prescription payment plan.
How does that work?
It allows beneficiaries to spread their out-of-pocket costs out monthly across the entire year with 0 interest, no extra fees. It's basically a buy now, pay later program for life-saving medication, but without the predatory interest rates. You just have to opt into it.
So seniors have predictable, manageable, strictly capped medication costs. Now let's connect all the dots. We started with the explosion in annuity sales, then corporate shakeups forcing seniors to find new Medicare plans. And finally, this new policy saving seniors thousands of dollars.
Right.
How are the insurance agents treating these 3 realities when they all intersect at the kitchen table?
Well, think about the agent's perspective. They sit down with a displaced senior who just lost their Cigna plan. The agent finds them new healthcare coverage and applies the new 2026 Part D rules. Suddenly, the agent can show the senior that their out-of-pocket drug costs are going to be thousands of dollars lower this year.
The agent gets to say, you budgeted $6,000 a year for your meds, but your new worst-case scenario is $2,100. You just found $3,900 of surplus in your budget.
And that is where the pivot happens. The industry data reveals agents are using this exact scenario to cross-sell. They take that newfound savings and present a solution to the client's other massive anxiety.
Outliving their money.
Exactly. The agent suggests redirecting those saved prescription dollars to buy those exact indexed annuities or final expense life insurance products we talked about at the beginning of our deep dive.
It all comes full circle. The money everyday people are saving at the pharmacy counter is directly fueling the $500 billion annuity boom Limeray reported. The anxiety over medical bankruptcy goes down, so the capital flows toward curing the anxiety of outliving their retirement savings.
It is a fascinating recalibration of the entire economic landscape. From corporate retreats in the Medicare space to new consumer caps, the entire landscape is recalibrating around managing long-term financial risk.
We set out today to connect the boardroom to your wallet, and the machinery operating behind the scenes is just incredible. The corporations pivot, the government caps prices, and the local agent brings that changing landscape right to your kitchen table to secure your future.
It's all interconnected. But it does leave us with a really provocative question to ponder.
Oh!
Yeah. We've seen how these new Medicare out-of-pocket caps successfully prevent people from being bankrupted by medical costs in the short term. But if these caps keep more money in your pocket, allowing you to afford the specialty medications that will ultimately extend your lifespan,
Oh, wow.
does that ironically increase your chances of outliving your retirement savings in the long term? Is fixing one financial crisis inadvertently accelerating the need for the other?
That is such a brilliant point. By fixing the short-term crisis of medical debt, you live longer, which makes the long-term crisis of longevity far more expensive. It is no wonder those annuity sales are breaking records.
It's the ultimate double-edged sword of healthcare and personal finance.
Well said. Thank you so much for joining us on this deep dive. We hope this look into the intertwined worlds of insurance, corporate strategy, and your personal health care costs has given you some valuable insights. Keep asking questions about where your money and your health intersect, because the answers are always evolving. Catch you next time.